Hello and welcome to another video in accounting. In this video we are discussing depreciation methods. There is another video on the channel in which we discuss why we need depreciation and what depreciation is. So do watch that video for more information on this topic. Just as a recap, why we need depreciation and what depreciation is. So first, depreciation is the allocation of the cost of the asset to expense over the useful life of the assets. Well, businesses buy assets with the intention of using them in the business. So as they are used, they help business earn revenue. So the cost of these assets should also be allocated to expense in each of the years the asset is used to earn revenue for the business. And this allocation of the cost is known as depreciation. Once depreciation is calculated, it has to be recorded. So we debit depreciation expense account and credit accumulated depreciation for that asset. The expense account, depreciation expense account, records the usage of the asset. Since anything that is used in the business is considered as an expense in accounting, and the asset usage is called depreciation, so it will be an expense. The credit should go to the accumulated depreciation account, not the asset account. So some people might be thinking that why not the entry should be like this: debit depreciation expense and credit the asset account. Well, the reason we do not credit the asset account is because of the accounting concept called historical cost concept. That concept tells us to keep the original value of the asset on the financial statement and use the accumulated depreciation account to collect the depreciation for each year, and then that will be deducted from the value of the asset on the financial statements. So the reason why we do not credit the asset account itself, instead we use accumulated depreciation, is because of the historical cost concept. There are three methods of depreciation. We have straight line method, unit of production method, and reducing balance method. In this video we will talk about straight line method. In our other videos we will talk about the other two methods. But remember, companies must choose the method that best matches the benefits from these assets. So companies look at the benefits that are coming from the asset and then choose the appropriate depreciation method that matches the benefits. What do you need to calculate depreciation? Well, we need three things to calculate depreciation. Number one is the cost of the asset. This cost of the asset is taken from the invoice or any other document for this asset. So for example, for this truck, when it was purchased, it came with an invoice, and so the invoice will give you the cost of this asset. Then you need the residual value of the asset. This is the estimated value of the asset at the end of its useful life. When the business uses the asset, it will sell an asset at the end of its usage. So the value it will get through selling it is called the residual value. So in case of the truck, when the business has fully used this truck, it will sell this truck, and what it will get from it through sale is known as the residual value. The residual value is estimated at the time of purchase for this asset or any other asset. So this is an estimate, and this is the amount that will not be depreciated because the business will get it back. And finally, we need the useful life of the asset, which is generally the number of years this asset will be used. So in case of this truck, we will require how many years the business will use this truck. So let's talk about the first method, which is the straight line method. The straight line method is used if the asset benefits all periods equally. Remember that we said we need to look at the benefits from the asset, and then those benefits, considering the benefits, we need to choose the depreciation method. So straight line method is used when the assets benefit all periods equally. So that if the asset does not uh, benefit all periods equally, more in one year, less in another year, then we need to use a different a different method of account for depreciation. To calculate depreciation, we need the cost minus residual value divided by useful life. This is the straight line method formula, and we will use that to calculate depreciation. So let's look at a few examples. Minkin Company has purchased a building for $2 million with a useful life of 50 years. At the end of 50 years, it will be sold for $100,000. So what is the depreciation expense for the year? So we are using a straight line method. The formula for straight line method is to take the cost minus residual value divided by useful life. Now look for these three things in the question. The cost of this building is 2 million. The residual value is 100,000. We will divide that by 50 years. This will give us depreciation of $38,000. So the usage, since the building is used, that becomes an expense. We call that depreciation, and it will be $38,000 of expense every year. Once we calculate this, we need to record this via journal entry. So debit depreciation expense 38,000, credit accumulated depreciation building $38,000. Let's look at one more example. Alpha Inc. owns a truck with an original cost of 200,000. On acquisition, management determined that the useful life was 10 years and the residual value would be $20,000. It also owns equipment depreciated over 4 years. It cost 50,000 and the residual value is 4,000. So what would be the depreciation under straight line method? Now the formula is this. Let's look at the truck first. So the cost is 200,000. The residual value is 20,000. We will divide that by 10 years to give us depreciation of $18,000. For the equipment, the cost is 50,000, residual value is 4,000, and divide by 4 years, the depreciation will be $11,500 per year. Once we know the amount, let's do the journal entries. So debit depreciation expense 18,000 and credit accumulated depreciation truck 18,000. Same thing for the equipment. Debit depreciation expense 11,500 and credit will go to accumulated depreciation equipment $11,500. Now let's look at a situation where the asset is purchased during the year. So when the asset is purchased during the year, calculate depreciation for time the asset was owned for that year. Remember that business has a start date and an end date for the year. The start date is usually January 1st and the end date is December 31st. So when an asset is purchased between these two dates, we need to only calculate depreciation from the date it was purchased, not from the beginning of the period. So here is an example. If the company year end is December 31st and an asset is purchased March 1st, 2023, we need to calculate depreciation for 10 months only. That is from March to December, not from January to December. So remember to only calculate depreciation from the time the asset was owned, in this case March 1st. Another example is asset was purchased October 1st, so we need to charge depreciation only for 3 months in the first year, which is from October to December, not the full year, because the asset was not for the full year. We call this pro rata depreciation. Let's look at a few examples. A machine cost $80,000. It was purchased on 1st July and has expected useful life of 5 years. Its expected residual value is $20,000. The entity financial year end is 31st December. So what is going to be depreciation for the year under straight line method? So here is the formula for straight line method. Let's find the cost, which is $80,000. Residual value in the question is given as 20,000 and the useful life is 5 years. So this will give us depreciation of $12,000. Remember that this depreciation is for one complete year. But this asset was not with the business from the beginning of the year. It was purchased on July 1st. So depreciation will be charged from July 1st, not from January 1st. So this asset was with the business for 6 months, from July to December is 6 months. So we need to charge depreciation only for 6 months. So that will be $6,000. Once we know the amount, we need to make an entry. So debit depreciation expense 6,000 and credit accumulated depreciation machine $6,000. Remember that the first year depreciation is 6,000, but in all the other years, the other 4 years, remaining 4 years of the asset, the depreciation will be 12,000 because the asset will be used for a complete year in each of those other years. It is only the first year that the asset depreciation will be different. Here's one last example. A business which has an accounting year which runs from 1st January to 31st December purchases a new non-current asset on 1st April 2023 at a cost of 24,000. The expected life of the asset is 4 years and its residual value is nil. What will be the depreciation for 2023? So again, this is the formula. Let's put in the values in this formula. $24,000 is the cost minus the residual value, which is 0, divided by 4 years, will give us depreciation of $6,000. And remember that this depreciation is for one complete year. This asset was not in the company or in the business usage for one complete year. It started using this asset from the 1st of April. So depreciation should start from the 1st of April until December 31st. That will be 9 months. So we will take 6,000 multiplied by 9 months divided by 12 months. That will give us $4,500 of depreciation for the first year. Once we calculate this depreciation, we need to record that in a journal entry. Remember that it will be the first year that will have a different amount as a depreciation, but in the other years of this asset, the depreciation will be $6,000. So this is the pro rata depreciation. So I hope this video was helpful. Do like and subscribe to the channel and click the notification icon so that you are aware of the upcoming videos. And I will see you in the next video.